solution that the Japanese have that we don't, and it doesn't solve the whole problem, but it's a start, is they could sell their 1.3 trillion of US treasuries. Because if they did that, then they could take the dollars they get, sell them, get Japanese yen. That'll push up the value of the yen, which will help bring down prices, especially for imports. Then the Japanese government could take those yen and buy back JGBs from the Bank of Japan, basically retire that debt. And then the Bank of Japan takes that money out of circulation. And so the Japanese money supply shrinks, and 13% of the Japanese national debt gets eliminated. Now that would fight inflation, and that would come at low political costs in Japan, because instead of asking the Japanese to pay to fight inflation, they would be asking Americans. Because one of the reasons that the Japanese own so many US treasuries is because they wanted to prop up the dollar. They didn't want the yen to get too strong because they wanted to maintain their exports to the United States. But we've just had a huge crash in the value of the yen. They need a stronger yen if they want lower inflation. So what they need to do is take our inflation that they imported and export it back to the United States. So the problem, of course, for America is that this solution for Japan just makes our problem even worse. Now, are they going to rush out and sell all of their 1.3 trillion in treasuries right away? No, but they're not going to buy any more. That's for damn sure. And I think they're already selling. And I think they're going to pick up the pace of selling treasuries because it is the most politically viable way to begin the inflation fight. Now, I don't know that they can win the fight just by selling US treasuries, but it's the best way that they can start, and they can't win a fight unless they get in the ring. And the best way to do that is, again, selling dollars, selling treasuries. But when Japan throws that punch, it's the US economy that gets knocked out. But even before Japan becomes a significant seller of US treasuries, Monday night's pivot to allow the yield on the 10-year JGB to rise indicates that the Bank of Japan has now joined the tightening party, having been the last holdout from that party. And this is going to further complicate the US stock market and the US bond market, because Japanese liquidity, which has been helping to prop up global markets, is now being withdrawn, and any assets that have been floating on that liquidity are going to sink. Imagine the ramifications politically of trying to avoid that. You're talking about massive tax increases on the Japanese or massive cuts to government spending. Now, the Japanese are actually wealthy enough to afford it. That's one of the big differences between Japan and the United States, is the Japanese can afford to pay higher taxes, we can't. But just because they can afford to pay higher taxes doesn't mean they want to. But they would not be in this predicament but for the asinine policies of Abenomics and this pursuit of this 2% inflation. And I warned all along that there's no way to fine-tune it. And just because you're trying to hit 2% doesn't mean you're not going to overshoot. In fact, I forecast that they would overshoot, and then it would be almost impossible to bring the rate back down. In fact, if you remember the rhetoric that was coming out of the Fed and Jerome Powell back in the early days when he became Fed chair, and it was pretty obvious that inflation was starting to pick up, yet he's kept rates at zero and continued quantitative easing. Powell's justification for keeping the monetary pedal to the metal, even when it looked like we could have a potential inflation problem, was that if we ended up with an inflation problem, according to Powell, it was a good problem to have. Because Powell said that unlike low inflation, which has been very difficult to overcome, we know how to deal with high inflation. We have the tools. All we have to do is raise interest rates and we can reduce high inflation. So high inflation would be a good problem to have because it's eluded us for so long. We've really tried hard to get to 2%, and we haven't been able to get there. So if we get to 2.25, 2.5, fantastic. We'll just dial it right back down to 2%, no problem. That's what he was saying. What I said was that when inflation gets to 2.25, 2.5, there's going to be no way to stop it. It's going to go to 3, 3.5, 4, 5, and higher. And that is exactly what happened. And I think the whole thing was BS on the part of Powell to even claim that type of ability on the part of the Fed. Powell was just looking for any excuse possible not to risk putting the economy into a recession. So instead, he risked something much worse. Remember, I said that Powell was betting the farm on transitory, that he basically went all in and bet the entire country, because I said if Powell was wrong and inflation wasn't transitory, he would have let a genie out of the bottle that he had no chance of ever putting back in, and it was going to do massive damage to the U.S. economy. Well, the Japanese have a similar inflation genie on their hands, but the Japanese have been creating this inflation problem for better than 30 years. So when it comes time to pay the piper, it's one hell of a bill, because they had a huge bubble in Japan during the 1980s in the stock market and in the real estate market. And the reason for that bubble was that the Bank of Japan kept interest rates too low. The main reason was to prevent the yen from rising too much against the dollar. Now, the yen went up, but it would have gone up even more but for the inflationary policies of the Bank of Japan. Now, this was misguided. It was their attempt to maintain the U.S. as an export market for the United States. So they artificially suppressed interest rates. The problem was it created a stock market bubble and a real estate bubble. These were very similar to the mistakes that the Federal Reserve made in the latter part of the 1920s when they tried to prop up the British pound, and that excess liquidity went into U.S. stock and bond prices. Well, the same thing happened in Japan. And when that bubble burst in 1989 and we had a big collapse in Japanese stock and real estate prices, instead of allowing the free market to correct all the mistakes that have been made and purge all the imbalances out of an otherwise very healthy Japanese economy, the Japanese government, the Bank of Japan, intervened to try to mitigate the decline. And of course, in the process, they prevented the mistakes from being corrected. They put a lot of zombie companies on life support that otherwise would have died, but out of their deaths, more economically viable companies would have been born. You would have had a Schumpeter creative destruction, which was badly needed in the Japanese economy. But instead of allowing a real recovery to take place, we had one phony recovery after another. That's how we had a lost decade and then another lost decade. It was because the government did not allow the free market to work under the theory that, well, the free market cure would be too painful. Well, it might have been painful, but it would have worked, and the pain would have been over a long time ago. It's kind of like ripping a Band-Aid off versus slowly peeling it off. The free market rips off the Band-Aid. What the government does is peels it off slowly. And in fact, if you want to judge the success of this interventionist inflationary policy, just take a look at the Japanese stock market, because it peaked in 1989 at just under 39,000. And if you look at the price today, 33 years later, it's 30% lower. And now obviously these stocks have paid dividends over the past 33 years, but the price is 30% lower 33 years later. That is an abysmal failure. And to put into perspective just how big the Japanese stock market bubble got when it peaked, if you look at the beginning of the rise, 1950, to the peak 40 years later, 1989, if an American investor invested 10,000 US dollars in Japanese stocks in 1950, at the high in 1989, that $10,000 investment would have been worth $12 million. Now, $4 million of the $12 million was from the appreciation in the stock. The other $8 million was from the tripling of the value of the Japanese yen relative to the US dollar. In contrast, if an American investor invested $10,000 in the Dow Jones in 1950, at the same point in time in 1989, that 10,000 would be worth 135,000. Again, I'm not counting dividends, I'm just looking at the price appreciation. But 12 million in Japanese stocks versus 135,000 in US stocks. That is an enormous difference. Now, all of that wasn't the bubble, but a good portion of it was. But I believe had the Japanese government not intervened after the bubble crashed and allowed the free market to function, not only would the Japanese economy be far stronger than it is today, and the Japanese standard of living much higher, and Japanese government debt to GDP significantly lower, but I also think the Japanese stock market would be significantly higher today than its 1989 peak. But unfortunately for the Japanese, the government intervened to try to protect them from a recession, and instead they got something much worse, and now they have an even bigger problem because instead of just slow growth, they have inflation.